So we have to get into a little bit of accounting now, because we're going to talk about a bank's balance sheet. So a balance sheet keeps track of assets, the things the bank owns, liabilities, its debts, and its net worth or equity capital. And those get used interchangeably. So the idea here is we have a sort of ledger, and on one side of the ledger we have a list of the bank's assets, and on the other side we have a list of its liabilities. And different people format a little bit differently, and then sometimes also equity capital. And there's what's called the fundamental accounting equation, and that is the idea that assets equal liabilities plus equity capital. I actually think this is a little bit of a less clear way of explaining it. My favorite way of explaining it is equity capital equals assets minus liabilities. So you can see that those are essentially the same equation. Those two are the same equation. This one emphasizes that the net worth, how much the bank is worth, or how much it has after it pays its debts, are equal to how much it owns minus how much it owes other people. You can look at it this way, though. Equity capital is a kind of claim upon the bank. It's the claim upon the bank by the shareholders. So just in a real simple case here, suppose we have a bank that hasn't taken any deposits yet, and I found this bank, and I found it with $100 cash, and I don't have any debts. So in that case, there's no true liabilities, I would say, but there is $100 of equity capital. And then I'm going to go ahead and try and attract some deposits. So I'm going to have a new balance sheet after I've successfully attracted some deposits. So I'm going to go ahead and attract $400 worth of deposits. From my point of view as a bank, those deposits are a liability because I owe the depositors money. I now have $500 of cash, though, because I had my original cash of $100 plus the $400 that the depositors gave to me. My equity capital is $500 minus $400. Notice that the balance sheet is called that for a reason. It has to balance on the two sides. Correspondingly, what happens here is when I attract deposits, I increase my cash assets, but I also increase my liabilities. So far, I'm not actually any better off. Now, what of course I'm going to go ahead and do is I'm going to lend out some of that cash. I'm also going to keep some of it on reserve because I want to guard myself against the possibility of bank runs. So we're thinking still about a really old school bank before we had federal deposit insurance and bank regulation and that kind of stuff. So let's say I'm going to go ahead and lend out, I'm going to keep 1/4 of the deposits on reserve. So because there's $400 worth of deposits, I'm going to keep $100 of cash reserves, and then I'm going to lend out $400 and hopefully make some money on that, because hopefully the interest rate I charge on the loans is greater than the interest rate I pay my depositors, and hopefully everyone pays their loans back. Okay, so far so good. And let's suppose then the next time period we're going to go ahead and and people are going to pay back their loans with some interest. So people pay back the $400 of principal plus, say, $40 worth of interest. I have $440 cash coming back. I had my $100 cash originally, so I have $540 of cash. I owe $40 of deposits. And so what's my equity capital? Well, I made some profits. So actually my equity capital has gone up. My equity capital is my assets minus my liabilities. 540 minus 400 gives me $140 of equity capital. And I really think this is the best way to think about it, because equity capital is a kind of residual. Equity capital, we assign its value to be whatever will make the two sides of the balance sheet actually balance. In this happy case here, happy for me as a banker, when there's an increase in assets, and assets have increased more than liabilities, my equity capital goes up. Let me go ahead and sort of keep this in the corner here so you can see it. Now let's go ahead and say that I loan out some more of this money. So I'm going to go ahead and still keep $100 cash reserves in case my depositors want their money back. I still owe $400 to my depositors, and I'm going to lend out $440 worth of loans. And I had $140 worth of equity capital. So far, so good. But then bad things are going to happen to me. And in particular, let's suppose that now not all of these loans are going to be repaid. And let's be relatively pessimistic and say that 350 of the 440 is repaid. So then at the start of the next period, I have this $100 cash I originally had, plus 350 of the 440 comes back in. So I have 100 plus 350, I have 450 cash. But I still owe my depositors 400. So my equity capital is now just 50. So the bank both gets to keep any excess, keep any profits, and also it suffers any loss. So any profits add to equity capital, any losses come out of equity capital. And so two things equity capital does. One is it is a safety buffer for depositors and others who have lent the bank money. This is the same thing that happens when the bank lends you money to buy a house. So if you put 10% down, we say that you have 10% equity in your house, and that 10% down forms a safety buffer for the bank, because if you don't pay your money back, as long as they can sell the house for 90% of what you bought it for, they can break even on the loan. So the more equity in the bank, the safer the bank is for the depositors. The larger your down payment, the safer that loan is when they lend you money to buy your house. A little bit trickier here is because any losses come out of equity capital before they affect the depositors, equity capital is basically what's at stake for the bank. So, or if you borrow money to buy a house, your down payment is what's at stake for you. That's how much money you've put down and how much of the bank's money is at risk. So, banks would love to be making large investments with small amounts of equity capital, but if banks make lots of loans with relatively little equity capital, there's not much of a safety buffer for depositors or other investors, and depositors or other investors may get nervous. Also, from a sort of risk management point of view, if banks are making a lot of loans and they don't have much of their own money at stake, then they may not be very careful. So one thing that we often look at here is what's called the leverage ratio. So the leverage ratio is the bank's total assets over its equity capital. So to calculate it here, in this situation, the bank's leverage ratio is, it had $540 of total assets, it had $140 of equity capital, so that's something a bit less than 4, call it maybe 3.8, and you can check that on your calculator. Down here, after the bank takes these losses, what's its leverage ratio now? Well, it has $450 worth of total assets, and it only has $50 of equity capital, so its leverage ratio is something like 9. So we'll go ahead and stop there because that's long enough.